Hello and welcome to Business Standards Morning Show. I am Ruchika Chatravanshi and let us take a look at the stories for today. In an aging world, India's population gave it an edge. More than 46% of the total population of 1.3 billion are below 25 years. But a recent government survey revealed that India's fertility rate is on the decline and is now lower than replacement levels, implying a population decrease in the years to come. Will it hurt the economy in the long run, or the concept of more the merrier doesn't hold water now? Our next report tries to find some answers to these questions.
A country's population, along with how fast it grows and its composition, has a significant impact on its economic growth. India's population is among the youngest in the world, so the country is said to be on the cusp of enjoying a demographic dividend if it plays its cards right. At the same time, another term, population explosion, is also brought up in this context. India's large population has for long been seen as a hindrance, constraining growth and development. So how will the decline in population affect the economy in the long run? Let's find out. According to the latest National Family Health Survey or NFHS released by the Union Health Ministry, India's total fertility rate has declined from 2.2 in 2015-16 to 2.0 now. So India's population is set to eventually fall. The replacement level, which is a woman giving birth to 2.1 kids in her lifetime, is a benchmark. It means that the population will remain stable as total births will be balanced by the total number of deaths in any country. If it is below 2.1, it means that the population is heading for a decline. According to the survey, there are only 5 states with a TFR above 2. These are Bihar with a TFR of 3, Meghalaya at 2.9, Uttar Pradesh at 2.4, Jharkhand at 2.3 and Manipur at 2.2. Among the larger states, Jammu and Kashmir has the lowest fertility rate at 1.4. To understand more about the kind of decisions that India should be taking at this stage, we have with us Dr. Sangamitra Singh from the Population Foundation of India.
First, I'd like to say that the decline in TFR, which has reached 2 now, this is on expected lines. If you look at the data from the last round of the survey of the National Family Health Survey, which was conducted in 2015-16, the TFR had already reached 2.2, just 0.1 over the replacement level fertility, which is 2.1, which is defined as the fertility rate at which the population exactly replaces itself. This means that we have started the process of population stabilization. India has a large young population. So 30% of India's population is young. The population will continue to grow for some more time. So this is called population momentum. So we will see this growth, the sustained population growth for another 2-3 decades. We have this very important window of opportunity right now, which is a large base of young people. A lot of states in the country are at different stages of their demographic transition. They need to come up with very focused and targeted strategies for their population groups. For the adolescent population, there needs to be greater investment in their health, education. For younger people, there need to be focused investments in employment opportunities. And at the same time, since we now know that we have a limited window of demographic opportunity, it's important for us to start preparing now to eventually be able to, cater to an aging population, which is going to be a challenge, say, in 2-3 decades, when our average population is older. So greater emphasis on social security, on geriatric care, etc., is really, really important. While we often talk about the demographic dividend, we also need to focus on the gender dividend. Investments in our young women and girls, they require very targeted efforts. They require a very holistic perspective where we empower them in terms of, not just in terms of education and providing them with employment opportunities, but also work towards greater gender equality and give them more reproductive autonomy and make sure that they are they're able to take their own health and fertility decisions. So truly leveraging the demographic dividend would require a very equal and strong emphasis on the gender dividend as well.
We also spoke to Professor K. Srinath Reddy, President of the Public Health Foundation of India, to understand the impact of a stable population growth on the economy.
Reaching the population stabilization level at 2% TFR is certainly helpful from the point of view of having less strain on our developmental process, and therefore to have a population which is stabilizing, but with the potential for having a large number of young people still over the next 20, 30 years, because most of the adult population is still fairly young. And even when they reproduce at this current level, we are still likely to have a fairly youthful population. And therefore, if we invest in health and in education, ensuring that their development is unimpeded in terms of health and nutrition, and education and skills are fostered, then we are likely to have our demographic dividend in terms of rapid economic growth. At the same time, since the population growth is going to be slowed down, the resources will not be scattered over a very large population, and therefore we will be able to raise the economic level and living standards, and thereby even the productivity of the people who are actually going to be benefited by the development programs. If we manage to limit our population growth, the stress on our environment is going to be much less.
Professor Reddy added that a significant importance must be given to nutrition, as the NFHS survey revealed that 67% of children under 5 and 59% of girls in the age group of 15 to 19 were anemic. Experts argue that India's demographic dividend will last for another 2 decades and possibly for a third. But we should aim to cash in on it sooner rather than later. And in that context, time is fast running out for India.
With India's population growth stabilizing, policymakers should capitalize on this opportunity and ensure that the country does not miss out on its demographic dividend. Entrepreneur and founder of InfoEdge, Sanjeev Bikhchandani, expects better outcomes from Indian startups in the future driven by smart founders, new technologies, and more capital deployment. He tells Business Standard's Surajit Dasgupta that ambitious startups should aim at customer satisfaction and cash flow, where valuation is a byproduct in their journeys to IPO.
Welcome to the morning show, Sanjeev. Recently, I think a few days ago, you have announced around about 360, 370 crores of investments in your 6 subsidiaries. So just wanted to understand, many of these subsidiaries do not have any revenues also. So what is the whole sort of plan now with these investments?
Well, these subsidiaries largely are vehicles through which we invest in various different startups. Mm-hmm. Therefore, the ultimate purpose of this money is to continue our investment activity into various different startups.
You had said that this is starting the 750 crore fund, and you had made many investments, like I remember Bulbul and very other areas. So how has that sort of grown? What has been your sort of success rate in?
It's early days yet, because we began the fund only 2 years ago. Mm-hmm. So typically, I mean, for example, in Zomato, we were in there for 11 years, still holding. Policy was 13 years, still holding. So it takes 3 to 4 years for these investments to come to any sort of fruition where you can confidently say, okay, this is working, this is not working. So it's still work in progress.
So which are the areas that you are looking at? Because obviously the whole startup space, you have, I'm quite sure, whole host of offers coming in.
So the broad areas are, what they were earlier: consumer internet, B2B SaaS, mobile, and obviously emerging technologies, machine learning, AI, analytics, all that. But typically we do not go in saying, here's a vertical, let's look at it. We do it bottom up. We meet startups, and the ones we like, we invest behind. We meet maybe 1,000 a quarter, and look at 1,000 a quarter, and then figure out which ones to do.
I mean, you look at around about 1,000 startups and then take a decision.
In a quarter. In a quarter.
In a quarter.
And we'll invest in maybe 2 to 3 of them.
What is the change that you see in the startups today compared to, say, around about 10, 12, 13 years ago when you started?
I think A, many more startups. B, many new technologies. C, very smart and ambitious founders. I mean, they're getting better and better by every passing year. So when I compare to when we were starting out, and I look at myself when I was, we launched Naukri when I was 33, 34. When I look at people who are 33, 34 today and are starting out, I mean, they're streets ahead of what I was. So I think that's the way, the ecosystem progresses. You get better and better people doing better and better startups, more and more investors coming into those startups, a lot more capital being deployed, hopefully much larger outcomes being delivered.
From the normal private equity funds, which look at an exit route within 5, 6, 7 years, you have obviously been very different in many ways because you're stuck around for a longer while. So
we haven't stuck around. We've continued to invest. For example, we invested first in Policy Bazaar in 2008, and we invested last in 2019. So we invested over 11-year period. So look, what India needs is patient capital because it typically takes a decade or more to build a good company. Right? And if you have a 6, 8, 7-year exit time horizon, then perhaps you end up putting undue pressure on the company, and they make suboptimal decisions, or perhaps you exit too early and don't make enough money. So we've been in Zomato for 11 years. The real value accretion, a lot of it came in the last 3 years, which means that year 9, 10, 11. Right? Now, a regular fund would have exited by year 6, 7, 8. So in India, you got to be patient, and therefore, because we invested from our balance sheet, we were able to be patient. We did not have somebody else's money to return in 6, 7, 8 years. Right? Even the fund that we today have established, first of all, there are only 2 LPs. Both LPs have got long-term time horizons on India and believe in the India story. And both have prop money, right? And our fund is 12 plus 2 years. It is one of the longest funds, VC funds in India. So we have enough time.
Okay.
We believe good founders need time.
If you look at the whole interest in IPOs with startups, many of them, which is like Zomato, which is already over, and obviously Paytm came in, and then there's a series of other, big valuation companies which have said that they are going to go for an IPO. And if you look at the valuation of those companies, for example, Baidu at $18.5, $19 billion. Paytm is a clear case that the valuation that they thought and what the market was, there's a big gap and a big difference. Therefore, the question a lot of people ask is that, is these companies overvalued, and ultimately, in the end of the day, the retailer gets to basically hold on the worst part of the brick in the whole process?
Well, you have to go IPO by IPO, company by company, right? And each company is different, right? So take a look at Zomato. I think 76 or 78 rupees offer price. It's at close to 150 now, almost double. Look at Policy Bazaar. I don't track it every day, but it's a good 25% above, 30% above offer price. Look at Nykaa. Nykaa, when I last check, was more than 100% above. I don't know what it is today. Look at latent view analytics, right? It's more than 100%. I think 150% above price. Of course, just because it is. But what I'm saying is that each company is different. And I wouldn't call a Zomato investor somebody who's lost out. I wouldn't call a Policy Bazaar investor somebody who's lost out. I wouldn't call a Nykaa investor somebody who's lost out. I wouldn't call a latent view investor somebody who's lost out. So I think you really have to be a little bit more discerning, granular, and figure out that you'll understand that in a lot of IPOs, investors have made a lot of money. And let me also tell you, Paytm, while it may have gone down, it's gone up 11% per day for the last 2 days. So there seems to be some recovery happening. It's not yet back to the IPO offer price levels. But look, like I've said it elsewhere, yes, market, it debuted softly with a drawdown over offer price, but it's coming back. And and I've said this in another channel. I mean, take a look at a company like Infosys. It had a problem in 1993 getting past the finish line on the IPO. It went on to be a great company. Take a look at Facebook. In a few months from the IPO, it was down by about 70% from its offer price. I think maybe 60%. I don't recall the exact number. And then it came back. So if a company is fundamentally good, right, and is growing, and the underlying is good, valuations come back.
So one should not bother so much about the valuation in the stock market because
no, obviously one should bother. But all I'm saying is that just because one IPO is currently below offer price, it's not the end of the world. There are many others that are not. And this one too has gained 11% a day for the last 2 days.
People are used to seeing profitability, which there is no clarity of the profitability of many of the companies which have gone IPO and which are doing well in a market where obviously even most unknown companies are also going up by 100%, etc., and all that stuff because there's a lot of speculation, there's a lot of hype. If you look at most of the IPOs which have come in, they have not given a very clear picture of profitability, of when they will become profitable. So is that an area of concern for these companies, for investors who have invested?
So I think let's first of all understand the SEBI rules for loss-making companies going public. 75% of the IPO has to be allotted to institutional investors, whether Indian or foreign investors. Now, institutional investors do their research thoroughly. They have access to data. They have analysts. They don't go in without proper diligence and study. So if IPOs have done well, if a Zomato was subscribed 38 to 40x, Policy Bazaar 18x, and Nykaa over 80x, right? And many of these have lots of institutional investors. I think people have done their homework and gone, right? So which means that you have smart investors, knowledgeable investors going in and taking the bulk of the allocation. Right? They must be seeing something. Okay. So now, as far as profits are concerned, I think I haven't really looked under the hood in any companies other than Zomato and Policy Bazaar because those are the ones we've invested in. I believe both of these companies can turn profitable should they want to, with some notice, maybe 2-3 quarters. Right? It's just that growth may come off a bit, and today they're probably prioritizing growth over profit. And that's a story they told the investors. That's what they said, we are prioritizing growth over profit, and that's what, for example, Zomato consistently says. Right? So it's not as if they've said something and done something else. People know what to expect. They came with eyes open. They are invested. Most are holding on. And the price is almost 100% above the IPO offer price. Because that's what people are buying, the growth story. Now, at some point in time, will they have to turn the switch and say, okay, let's go for profit now next 3-4 quarters? Maybe 2-3 years they might have to. But let's wait and see. Hey, thanks so much. Thanks,
yeah. Okay. Thanks a lot.
Even as benchmark indices have declined up to 4% over the past 1 month, analysts say the correction is on the course. Devang Mehta of Centrum Wealth and Varun Locha of HDFC Securities decode investment strategies to ride the ongoing correction.
The bull run, which began in March 2020, is beginning to plateau. Over the past 1 month, the BSE Sensex index has declined 4%, while the Nifty 50 has slipped 3%. But investors should not panic at the moment, as the correction has come on the back of over 30% returns, delivered by frontline indices over the past 1 year. In the broader markets, the returns have been up to 76% during this period. While global headwinds and rich valuations are the key triggers for the ongoing profit booking, the outlook for Indian markets remains healthy on a broad basis. We caught up with Devang Mehta, Head of Equity Advisory at Centrum Wealth, to share his views.
In the past few months, we have seen a fast and furious rally which had led markets ahead of fundamentals, and hence a small correction and consolidation should probably be the order of the day. And that is what we are seeing in the past few days. The reasons can be a flurry of IPOs, which are sucking out liquidity from the secondary markets. This money is getting into the primary markets. A lot of FIIs we have seen are getting into the anchor investors mode in a lot of large size IPOs. Volatile crude and commodities across the world have also not helped the prospect of equities in the past, I can say, couple of weeks. Global inflation and interest rates worries also are taking center stage at this point of time. However, if we look at the Indian macros and micros, it's never been so good. The confluence of macros and micros in terms of GST collections, in terms of direct tax collections, I think has sort of set new records. Sentiment post-reduction in COVID numbers, also the acceleration of the pace of vaccination has also sort of brought in a lot of demand. We call it revenge tourism, you call it revenge shopping. I think consumers have started to show confidence as well as the economy has started to sort of bounce back. The return of capex is also a sort of good news for the economy. India INC has sort of delivered good numbers, I think ahead of expectations or in line with expectations in the last quarter as well. However, it can't be a one-way street, right? So structural bull markets always have ebbs and corrections in between.
As pointed out by Mehta, the Indian economy remains on a strong footing and investors should use the correction dip in prices to add quality names to their portfolio. Here's what he suggests.
The way forward has to be the businesses with dominant market share, high ROE, high ROCE, moat, pricing power. All these businesses which have historically done well should form part of the portfolio. The companies which are exhibiting this type of growth profile should be part of the portfolio. Market leading businesses with dominant market shares and companies which probably are not showing that sort of growth should find its way out of the portfolio.
Varun Lochab, institutional research analyst at HDFC Securities, meanwhile believes the best way to tackle markets is to remain stock and sector specific. He suggests sticking to large cap IT, banks, gas and insurance related stocks. Besides, the brokerage is underweight on consumption, staples, discretionary and autos, NBFCs and small banks. That said, gradual market correction may continue over the near term as possibility of sooner than expected interest rate hike makes investors risk averse. Recently released minutes of the US Federal Reserve's November meeting showed that policymakers are concerned about inflation and are willing to raise interest rates if prices keep rising. The minutes stated that various participants noted that the Federal Open Markets Committee, US Fed, should be prepared to adjust the pace of asset purchases and raise the target range for federal funds rates sooner than currently anticipated if inflation continues to run higher than levels consistent with the committee's objectives. Given this, Philip Murray, who's senior US strategist at Rabobank International, believes that the taper schedule is rapidly turning into straitjacket, preventing the FOMC from hiking rates in time in response to inflation. Consequently, the markets are likely to see an increase in the pace of tapering at the December meeting. Therefore, global markets' reaction to these developments, along with stock-specific news flows and FII activity, will guide the domestic equity markets on Friday. That apart, Tarson's products will debut on the bourses today. Grey market trends suggest a 20 to 30% listing gain.
Most of us have heard about FDIs and FPIs, and we know that they refer to investments coming from foreign countries. But what exactly are these? What are the kinds of investment they bring in, and what is the difference between them? Let us understand in our next report.
Just like private companies, every country needs money for its growth. While the private firms and individuals turn to banks for it or take some other routes, nations look forward to foreign investors. So, the two most common routes through which the capital comes into any country are FDI or foreign direct investment and FPI or foreign portfolio investment. Now, let us first see what the FDI is. Foreign investors take the FDI route when they have a long-term interest in mind. In FDI, an investor usually acquires foreign business assets, establishing ownership or controlling interest in a company. With FDI, foreign companies are directly involved with day-to-day operations in the other country. This means they are not just bringing money with them, but also knowledge, skills, and technology. Under such circumstances, the investor company has at least 10% stake in the company, thus commanding a substantial amount of influence and control over the investee company. For example, Walmart acquiring 77% stake in India's biggest online retailer, Flipkart, is an FDI investment. Now, let us explore the ways through which the FDI comes into India. According to the rules prescribed by the Indian government, FDI can either come via automatic route or via government route. In the automatic route, non-resident or Indian companies do not need prior nod of RBI or the government for FDI. It is for the sectors where the FDI is not restricted and doesn't need government scrutiny. And the second is the government route. For this, the company will have to file an application through Foreign Investment Facilitation Portal, which facilitates single window clearance. So, if FDIs get ownership in a company, what do FPIs get? Let us find out. Unlike the FDI, Foreign Portfolio Investment or FPI is meant for short-term profit booking. Through this route, foreign investors put capital in financial assets such as stocks and bonds. In other words, FPI involves the purchase of securities that can be easily bought or sold. Such an investment is made with the aim of making short-term financial gain and not for obtaining significant control over managerial operations of the enterprise. In a nutshell, FDIs own controlling stake in a company by investing in its physical assets, while FPIs invest only in financial assets. While FDIs is a more stable long-term investment, FPI money is usually considered hot money. Now, let us understand which one is a better investment route. FDI or FPI are both important sources of funding for most economies. However, FDI is preferred by most countries for attracting foreign investment, since it is much more stable than FPI and signals long-lasting commitment. FPIs, on the other hand, have a higher degree of volatility because of its tendency to flee at the first signs of trouble in an economy. These massive portfolio flows can exacerbate economic problems during periods of uncertainty.
That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.